Hello, everybody, and welcome. Today, my guest is Gary Monaghan. Gary is a specialist for Asian equity at Fidelity International. Welcome, Gary.
Hi, Thomas. Thank you for your time.
Gary, COVID-19 currently is in the center of the discussion about capital markets. So what is currently the case for investing in Asia right now?
I would say COVID-19 has certainly dominated news flow and has been the driver to returns in various industries. But there's also an argument at the moment that we know about COVID-19, the lockdowns, potential vaccinations and the like. So the future impact of any news flow may well be more muted than we've actually previously seen, because investors like ourselves have already factored in a whole range of potential outcomes when we assess companies. Now, looking ahead, if we think about the markets as we look ahead, high-level topics that are increasingly being discussed and may well have a bigger impact on Asia going forward could be things like the US election and the outcome there, US-China relations, will inflation return, and also this value versus growth argument. But going to the actual question, why Asia now? First of all, economic activity is returning. It's certainly in what we would broadly call North Asia, so Korea, Taiwan, China, and here in Hong Kong, the government response to COVID-19 was pretty severe. I mean, I felt that as a resident here in Hong Kong. It was pretty severe, very swift, but it's actually created quite a stable base for economic activity to return. And just to give you a few data points on that, just looking at flash data reports, daily subway usage in China is now only around 10% below levels this time last year. Domestic travel is around 80% of the levels seen 12 months ago, and retail sales have actually just hit positive year-on-year growth, and that's retail sales in goods. But even in economies where we've seen high cases and lockdowns occur, like India, we've seen some positive signals too. So in September, high frequency data that we look at showed positive signals. So car sales were up year on year, and even cement volumes carried on the railways are actually up year on year as well. So there's some real positive signals from an economic activity viewpoint, which I think are quite positive, and something investors should certainly be aware of.
So many stocks have returned to their pre-COVID-19 levels while profits have been falling. So is there still upside potential for Asian stocks?
What I would say is that if you just go off and buy the index, it's probably going to be more difficult to make money in the next 6 months than it was in the last 6 months. So the key thing is to be very, very selective. And there are certainly industries where profits are under a bit of strain. The property sector, for example, particularly those who are in the in the rental market, people are negotiating lower rents, right? They're going to struggle for a bit in terms of growing their profits in the near term. But there are actually individual companies as well that are really emerging very, very strongly from this. And to give you an example, this week, TSMC, so Taiwan Semiconductor Manufacturing Corporation, again delivered a beat and a raise on their margins. And the capital guidance is above expectations as well, which indicates they've got a positive view for 2021. So there are, whilst markets have gone up and there are industries that are potentially going to struggle going forward with everything that's gone on and let's face it, lower economic activity than what we've seen, let's say, a year ago. But there are certainly companies and industries that will emerge. But the key thing is you've got to be selective going forwards.
Especially technology stocks seem to be the winners of COVID-19. If you have a look at stocks like Alibaba or Tencent, their PEs, they exploded. So how is your take on current company valuations in China and especially on technology stocks there?
Yeah, so if we think about technology, I think it's very important to distinguish between internet-related names, the social media platforms and the e-commerce platforms, versus let's say the tech hardware and the component names, so the more tangible side of technology. For the social media and e-commerce platforms, the likes of Alibaba, Tencent, JD.com, Pinduoduo, and others, sentiment has become ultra positive. I mean, everyone talks about it. And the stocks have re-rated, and valuations in our minds are at really quite elevated levels. Now, with these types of stocks, the risk reward at the moment, given those valuations, is just not compelling, and we're staying away. When you pay such high valuations, you need to be certain that the company is effectively going to be growing and has an easy runway for growth for the next few years. But when you speak to investors about these names and you sort of gauge the pulse of the market and the street around these sorts of names as well, they'll give you all these great stories about the next few quarters, which, okay, yeah, we can see that and understand that. But when you're being asked to pay extremely high valuations, you need to be more certain beyond just a couple of quarters. And so with that in mind, we're quite cautious on the risk reward.
Tourism is one of the mega trends in Asian consumption, and we all know that especially the tourism industry has been hit very hard by COVID-19. So what are the perspectives for tourism in Asia, and what is your outlook?
So if you're actually talking about the outlook for tourism, so people just getting on an airplane and going somewhere and staying in hotels, it's pretty bleak. And actually that's what creates the investment opportunity. So if you can dare to tread where others don't, that's where the potential value for you as an investor lies. And so therefore, what we've been doing is actually picking up stocks related to the tourism industry, broadly related to the tourism industry. And we see value there, which we think can hopefully be unlocked over the coming years. Sentiment is massively negative, right? No one's traveling, but we know that. And so with that said sentiment, you've seen big derating of those stocks. So if you take a 2-year view though, do we think that there'll be zero travel in 2 years? Highly unlikely, right? A lot of the lifeblood of the big cities and countries like Thailand is about tourism. So they're going to have to find a way to open up again. So things will return. So whilst valuations are, well, when they were at rock bottom in March, we were buying into that industry, buying names like Flight Centre, which is a travel agency in Australia, Auckland International Airport, which is obviously the monopoly airport in Auckland, Galaxy Entertainment. So Macau borders were shut. No one was going to stay in the complexes in Macau. However, tourism will return there. And so we were buying Galaxy Entertainment, a company with an incredibly strong balance sheet, an interesting long-term structural runway for growth.
With the Asia Pacific Opportunities Fund, you are following a high conviction strategy. How exactly does it look like, and where do you currently find value and investment opportunities for your strategy in Asia?
So the Fidelity Asia Pacific Opportunities Fund is a 25 to 35 stock portfolio. So it's a high conviction approach, investing in companies across the entire Asia Pacific ex-Japan region. What we like to say is we're looking to make money anytime, any place, anywhere. So we're pretty agnostic as to whether a stock is considered growth or value or anything else in between. If we think that there is an opportunity to make money for our investors, we will go for it. When we see an opportunity that we think we have a differentiated view and there's a valuation anomaly, we will put significant capital to work. A minimum position size will be 1.5%. If it's a relatively small cap or a liquid stock, we will max that position at around 2.5%. But if it's a large cap, highly liquid stock that shows low correlation against other stocks within the portfolio, and we've got a very high conviction on the fundamental outlook, we think there's valuation support, we will go up to 10%. And we've done that a few times in the past. Ultimately, we want each position to have a significant contribution to performance. Now, we want to beat the benchmark. We want to beat the MSCI Asia Pacific ex-Japan benchmark. But when we're constructing the portfolio, we just don't pay very much attention to the benchmark whatsoever. Now, to give you a bit of an analogy, if you're playing football, as I do from time to time, if you're playing in a team and you concentrate on the other team, you start to think about the other team, you start to play like the other team, and you don't actually do what you should be doing, which is play to your own strengths. And it's the same with us when we think about the benchmark. If you think about the benchmark, you're worried about the benchmark, you start to drift towards the benchmark, you perform like the benchmark. If you play to your own strengths, which in Fidelity's case is bottom-up stock picking, and you put capital to work and you go into a highly concentrated portfolio, you are basically giving yourself the best opportunity to outperform, because you're not thinking about the benchmark, you're being different to it. And because we believe in our stock picking capabilities, we give ourselves a greater opportunity to outperform. The critical thing though is that everyone says, oh, right, okay, you've got a concentrated portfolio, there's 25 stocks in the portfolio, surely you've got higher risk. We pay a lot of attention to portfolio construction, particularly around the correlations between the holdings that we have. And by making sure that we have a portfolio where there's correlations between the holdings are fairly low, we've been able to maintain a total return that is below that and sometimes similar to that of the index. So where are we finding opportunities? In terms of technology, we're finding some very interesting opportunities related to semiconductors and maybe more tech hardware side of the space. Work from home, obviously, is a big trend. This requires things like memory and digitalization of businesses is that everyone's forced to work from home and they have to think about cybersecurity and all of these technology things in the background that enable us to work from home in a safe way. Is a very, very, very strong demand for a lot of technology names in areas like chip manufacturing and memory. So, for example, we bought SK Hynix back in March, and it's around 3% of the portfolio. Also in the technology hardware space, we own TSMC, which is a foundry business for the microchip sector. These guys are the foundry business for the world. They operate and they work with anyone and everyone, so they don't have any biases. And we were actually selling out of this stock at the beginning of this year. It's been a long-term holding, but we felt that valuation was getting a little bit fair. Plus, you had this whole issue with Huawei, which is a customer of TSMC, and what happens if Huawei goes out of the game? What's going to replace that revenue stream? However, in July this year, at the time when we had sell orders in the desk to get out of the position, Intel turned around and they announced that basically they were unable to fulfill a bunch of deliveries on their processors, and because they were struggling to make what they call 7 nanometer chips that go into this processing unit. And with that, they basically announced that rather than be a producer of these chips, they're going to have to outsource that. So what happened in that day, Intel moved from being a potential long-term competitor to a potential customer. And overnight, the industry moved to a duopoly. And the industry structure change was very, very interesting to us. And we felt that actually that generated a much more interesting long-term runway for growth for TSMC. And so therefore, literally on that day, whilst we had sell orders on the desk, we reversed them and we bought a significant position back into TSMC. We also own a number of stocks in Hong Kong. Significant negative sentiment to Hong Kong around politics. But actually, when you look at a number of companies in Hong Kong, the domestic economy doesn't have that much of a bearing on the underlying business. And so what you find is that when there are negative news flows around things like politics, when it comes to Hong Kong, the market gets sold off, the businesses don't change. And so again, there can be valuation anomalies that we take advantage of.
So this was Gary Monaghan from Fidelity International. Thank you very much, Gary, for being with us today and sharing your views.
Thank you very much for your time, Thomas.